Imagine having $10,000 in your bank account. It feels safe, right? But here's a twist. Every day, that cash might be silently eroding in value. Why? Because of an invisible force called inflation, along with risks like devaluation and theft. This reality shakes the very foundation of what we've been taught about financial security. In this video, we're diving deep into a treasure trove of knowledge to unearth 10 assets that outshine cash in both security and growth potential. This journey is not just about preserving wealth. It's about embracing strategies that savvy investors have used for generations to combat economic turbulence. Now, let's set sail into the tumultuous sea of global finance, where safe haven currencies serve as our first lifeboat. In times of economic uncertainty, these currencies are like beacons of stability. They include the stalwarts of the financial world, the US dollar, Swiss franc, Japanese yen, and euro. Each backed by robust economies, low inflation rates, and solid political frameworks, these currencies are the investors' go-to in stormy market conditions. But why do safe haven currencies act as such strong bulwarks against market volatility? It's because they represent economies with significant global influence and financial stability. Investors flock to them in times of crisis, driving up their value as demand surges. Moreover, their liquidity means you can quickly move in and out of these currencies, providing a flexible strategy for safeguarding your wealth. Incorporating safe haven currencies into your investment portfolio requires understanding the nuances of foreign exchange markets. Platforms like Rwanda offer a gateway with low spreads and advanced trading tools, making it accessible even to novice traders. Meanwhile, investment vehicles like the Invesco DB US Dollar Index Bullish Fund, UUP, provide a more straightforward approach to gaining exposure to the US dollar's movements against a basket of currencies. The wisdom of seasoned investors like Ray Dalio illuminates the path. Dalio diversifies with safe haven currencies, balancing his portfolio to weather various economic scenarios. This strategy is not just about avoiding loss. It's about positioning for gain amidst global financial shifts. To embark on this voyage, one must be equipped with knowledge and caution. Safe haven currencies, while less volatile, are not immune to global economic shifts. Your compass? Thorough research and a keen eye on geopolitical events and monetary policies that influence these currencies' strength. As we anchor this segment, reflect on the power of safe haven currencies. They're not just financial instruments. They're havens in the stormy seas of the global economy, providing a blend of security, liquidity, and potential for appreciation. As we continue our exploration beyond the realm of cash and digital figures, we delve into an asset class that embodies the very essence of tangible value: goods money. This asset class, comprising physical commodities like metals, oil, and agricultural products, offers a compelling narrative of wealth protection and potential growth in an ever-evolving economic landscape. Goods money stands as a bastion against the erosive forces of inflation and market volatility. Consider precious metals such as silver and platinum, whose lustrous appeal goes beyond aesthetics to signify enduring value. These commodities serve as critical components in various industries, from electronics to renewable energy, underscoring their intrinsic worth and limited supply. Moreover, the strategic importance of oil and natural gas cannot be overstated. As the lifeblood of the global economy, these energy commodities are pivotal in driving industrial growth and innovation. Their value fluctuates with geopolitical events, technological advancements, and shifts in global demand, presenting both challenges and opportunities for the astute investor. The allure of goods money lies in its ability to offer a hedge against currency devaluation. As fiat currencies face downward pressure from inflationary policies, commodities often see an uptick in value, serving as a counterbalance to paper money's diminishing purchasing power. This protective shield is particularly valuable in times of economic uncertainty, where traditional assets may falter. Investing in goods money, however, requires a keen understanding of market dynamics and a proactive approach to risk management. The prices of commodities can be influenced by a myriad of factors, including weather patterns affecting agricultural outputs, mining strikes impacting metal supplies, and energy policies shaping oil and gas production. For those inclined towards this tangible asset class, avenues such as exchange-traded funds, ETFs, that track commodity indices offer a practical entry point. These financial instruments allow investors to gain exposure to the broad spectrum of commodities without the complexities of direct trading or the physical storage challenges associated with owning tangible assets. The narrative of goods money is rich with examples of investors who have navigated this space with remarkable acumen. Consider the legendary John Templeton, whose diversified approach included strategic investments in precious metals and oil, showcasing the potential for commodities to enhance portfolio performance and serve as a bulwark against inflation. As we conclude this segment, the journey through the world of goods money reveals it as a realm of both opportunity and complexity. For investors seeking to diversify beyond cash and equities, commodities offer a pathway to tangible assets that resonate with the rhythms of the global economy, embodying both the challenges and rewards of the investment landscape. Embarking further into the terrain of tangible assets, we explore the vital arteries of the global economy: industrial commodities. These are not just raw materials. They are the building blocks of civilization, powering everything from the construction of cities to the vehicles that connect them. This session dives into the strategic importance of commodities such as copper, aluminum, zinc, iron ore, and crude oil, and their pivotal role in propelling economic growth and innovation. Industrial commodities represent a compelling investment narrative due to their direct link to global economic health. As nations develop and infrastructure projects expand, the demand for these essential materials escalates, driving their value upward. Investing in these commodities offers a unique vantage point on the world's economic pulse, with the potential for significant returns as emerging markets grow and urbanize. The allure of investing in industrial commodities lies in their inherent volatility and the opportunities it presents. Prices can surge on the back of increased demand, supply disruptions, or geopolitical tensions, offering savvy investors the chance to capitalize on these fluctuations. However, this volatility also demands a nuanced understanding of the factors at play, from global economic trends to technological advancements that may affect demand. Diversification is a key advantage of adding industrial commodities to your investment portfolio. Their performance often diverges from traditional assets like stocks and bonds, providing a hedge against market downturns and inflation. This diversification can smooth out portfolio returns over time, mitigating risks and enhancing overall performance. For individual investors, accessing the world of industrial commodities has never been more straightforward. Commodity futures contracts offer direct exposure, allowing investors to speculate on price movements. Meanwhile, exchange-traded funds, ETFs, and stocks of companies in the commodity production sector offer more accessible and diversified entry points, enabling investors to leverage the growth of industrial commodities without the complexities of direct commodity trading. Prominent investors and institutions have long recognized the value of industrial commodities. Major investment firms and hedge funds strategically allocate portions of their portfolios to commodities, seeking to harness their growth potential and hedge against inflation. These seasoned investors navigate the commodity markets with a blend of analytical rigor and strategic foresight, setting a benchmark for individual investors to emulate. As we wrap up this exploration of industrial commodities, it's clear that their role in the global economy and investment portfolios is both foundational and dynamic. They offer a conduit to participate in the world's economic development, with the promise of growth and the challenge of volatility. Venturing into the domain of tangible assets and enduring value, we uncover the allure of real estate investment trusts, REITs. REITs stand as a testament to the timeless adage that land is wealth. By enabling investors to partake in the lucrative world of real estate without the need to directly buy or manage properties, REITs democratize access to a sector historically reserved for the affluent. This session navigates the landscape of REITs, highlighting their potential for generating income, providing portfolio diversification, and offering a hedge against inflation. REITs operate by pooling investor capital to purchase and manage a diversified portfolio of real estate assets, ranging from apartment buildings and office spaces to shopping malls and data centers. One of the hallmark benefits of investing in REITs is the potential for steady income through dividends, derived from rental income and property sales. This characteristic makes REITs particularly appealing to income-focused investors seeking regular returns. Diving deeper, the structure of REITs mandates that they distribute at least 90% of their taxable income to shareholders in the form of dividends, ensuring that investors directly benefit from the trust's earnings. This requirement not only underscores the income potential of REITs but also highlights their commitment to shareholder returns, distinguishing them from other investment vehicles. Moreover, REITs offer a practical solution for portfolio diversification. By investing in a variety of property types across different geographic regions, REITs spread risk and minimize the impact of individual asset underperformance. This diversification extends beyond the real estate sector, as the performance of REITs often diverges from traditional equity and bond markets, providing a buffer during periods of stock market volatility. The path to investing in REITs is marked by accessibility. Publicly traded REITs, available on major stock exchanges, allow investors to buy and sell shares with the ease of trading stocks, offering liquidity and flexibility uncommon in direct real estate investments. For those seeking more exclusive opportunities, private REITs present options with potentially higher returns, albeit with higher entry thresholds and reduced liquidity. The annals of real estate investment are adorned with the successes of visionaries like Sam Zell and David Simon, who have harnessed the power of REITs to amass substantial wealth. Their journeys illuminate the strategic potential of REITs to capitalize on market trends, demographic shifts, and economic cycles, providing a blueprint for aspiring investors. As we conclude this exploration of REITs, we recognize them as more than just an investment vehicle. They are a bridge connecting individual investors to the vast potential of the real estate market. With their unique blend of income generation, diversification, and accessibility, REITs stand as a cornerstone of a well-rounded investment portfolio. Embarking on a journey through history, culture, and wealth preservation, we explore the realm of gold and precious metals. Revered since ancient times, these metals have not only adorned monarchs and sparked expeditions but have also acted as steadfast guardians of wealth through countless economic cycles. This session uncovers the allure of gold, silver, platinum, and palladium, highlighting their role in diversifying investment portfolios, hedging against inflation, and offering a safe haven during tumultuous times. Gold, often referred to as the king of metals, holds a special place in the investor's arsenal. Its value stems not just from its physical beauty and rarity but from its historical role as a form of currency, a symbol of wealth, and a hedge against monetary instability. Unlike paper currency, gold's intrinsic value offers protection against inflation and currency devaluation, making it a critical asset in preserving purchasing power over the long term. Silver, while often in gold's shadow, presents its own unique investment opportunities, with applications ranging from jewelry and silverware to industrial uses in electronics and solar panels. Silver's demand dynamics provide a blend of investment security and growth potential. Its price not only reflects investor sentiment but also the balance between its industrial demand and supply, making it a versatile component in any investment portfolio. Platinum and palladium, though less renowned than gold and silver, play crucial roles in the automotive industry as components of catalytic converters, reducing vehicle emissions. Their value is underpinned by stringent environmental standards and the automotive sector's health, offering investors exposure to industrial growth trends. Additionally, their rarity and specific use cases in technology and medicine add a layer of speculation and potential for price appreciation. Investing in precious metals can be approached through various avenues, from owning physical bullion and coins to investing in ETFs that track metal prices or stocks of mining companies. Each method offers different levels of exposure, liquidity, and risk, allowing investors to tailor their precious metals investments to their financial goals and risk tolerance. The narrative of precious metals is interwoven with tales of investors who have navigated their cycles with foresight and strategy. Figures like Peter Schiff and Ray Dalio have advocated for gold's role in a diversified portfolio, especially in times of economic uncertainty. Their perspectives underscore the strategic use of precious metals to balance portfolios, mitigate risks, and capitalize on long-term wealth preservation. As we encapsulate our exploration of gold and precious metals, we recognize their unbroken luster not just in adornment but as pillars of financial prudence. In an ever-evolving economic landscape, they remain enduring symbols of wealth, security, and prosperity. As we navigate the vast landscape of investment opportunities, dividend stock funds emerge as a beacon for those seeking a blend of income and growth. These funds pool resources to invest in a diversified portfolio of dividend-paying stocks, offering investors a share in the profits of some of the world's most successful companies. This session will explore how dividend stock funds operate as engines of income, providing a steady cash flow while offering the potential for capital appreciation, making them an attractive option for long-term wealth building. Dividend stock funds focus on companies that not only pay dividends but have a history of increasing them over time. These companies are typically well established, with stable earnings and a strong commitment to returning value to shareholders. Investing in these funds allows individuals to participate in the financial success of these corporations without having to individually select stocks. Reducing risk through diversification. The allure of dividend stock funds lies in their dual potential for generating income and capital growth. Dividends provide a regular income stream, which can be especially appealing during retirement or in low interest rate environments. Meanwhile, the potential for capital appreciation offers an opportunity for wealth accumulation, as reinvested dividends compound over time, accelerating portfolio growth. The strategy behind selecting the right dividend stock fund involves looking at factors such as the fund's dividend yield, the growth rate of its dividends, and the overall health of its underlying holdings. High dividend yields are attractive, but they must be balanced with the sustainability of payouts and the potential for dividend growth, which are indicators of a company's long-term viability and financial health. For investors seeking to harness the power of dividend stock funds, the journey begins with setting clear financial goals and understanding one's risk tolerance. These funds can serve as a cornerstone of a diversified portfolio, providing both stability in the form of regular income and the potential for growth. However, like all investments, they come with risks, including market volatility and the possibility of dividend cuts in economic downturns. The narrative of dividend stock funds is enriched by the stories of legendary investors like John Templeton and Warren Buffett, who have long championed the virtues of investing in dividend-paying companies. Their investment philosophies underline the importance of patience, discipline, and a focus on long-term value creation, principles that are central to successful dividend investing. As we wrap up our exploration of dividend stock funds, we recognize them as more than just investment vehicles. They are pathways to financial independence, offering a balance of immediate income and the promise of future growth. In the quest for financial security and prosperity, dividend stock funds stand as a testament to the enduring power of dividends in building and preserving wealth. In the diverse universe of investment opportunities, government bonds stand out as the bedrock of stability and security. These debt securities, issued by national governments, are designed to raise capital for public projects and governmental funding. They offer investors a relatively safe avenue for earning interest, making them a cornerstone for conservative investment strategies and a bulwark against the volatility often encountered in equity markets. This session will dive into the characteristics of government bonds, their role in a diversified portfolio, and how they can serve as a predictable source of income while preserving capital in uncertain times. Government bonds are essentially loans made by investors to the issuing government, in return for regular interest payments over the bond's term, culminating in the return of the principal amount at maturity. The interest rate, or yield, of government bonds is a reflection of the country's economic health and the perceived risk of lending to the government. Bonds issued by stable, low-risk countries typically offer lower yields, while those from countries with higher perceived risks offer higher yields to attract investors. The fixed interest payments provide a steady income stream. One of the primary attractions of government bonds is their predictability, making them particularly appealing to retirees and others who rely on their investments for regular income. Furthermore, because they are backed by the full faith and credit of issuing governments, the risk of default is generally considered low, especially for bonds from financially stable countries. Investing in government bonds can be approached through direct purchases of individual bonds or through bond funds that pool together securities from various issuers. While individual bonds allow for precise control over maturity dates and yields, bond funds offer diversification and professional management, albeit at the cost of ongoing fees and potentially lower yields. The strategic integration of government bonds into an investment portfolio enhances its diversification, reducing overall volatility and risk. By balancing higher-risk assets like stocks with the stable income and principal protection offered by bonds, investors can tailor their portfolio's risk-return profile to match their financial goals and risk tolerance. Legendary investors such as Bill Gross, known as the Bond King, have demonstrated the potential of government bonds to form the backbone of successful investment strategies. Gross's expertise in bond investing underscores the importance of understanding interest rate movements, inflation trends, and geopolitical developments in maximizing bond investment returns. As we conclude this exploration of government bonds, we are reminded of their indispensable role in providing financial stability and security. In a world of uncertain markets and economic fluctuations, government bonds offer a haven of predictability and safety, serving as the foundation upon which resilient investment portfolios are built. In the ever-evolving landscape of investment opportunities, cryptocurrencies have emerged as the new frontier, heralding a digital gold rush that combines the allure of potential high returns with the thrill of navigating uncharted financial waters. In this session, we explore the realm of cryptocurrencies, such as Bitcoin and Ethereum, exploring how these digital assets are reshaping the investment world, challenging traditional concepts of currency, and offering investors both unprecedented growth potential and inherent volatility. Cryptocurrencies operate on blockchain technology, providing a decentralized, secure, and transparent method of conducting transactions. This foundational technology not only challenges the traditional banking system but also offers a new paradigm for asset ownership and exchange. The appeal of cryptocurrencies lies in their potential to act as both a new form of currency and an investment asset, offering possibilities for significant appreciation in value. The volatile nature of cryptocurrencies is both a draw and a challenge for investors. Price fluctuations can be dramatic, offering the potential for high returns but also posing a risk of substantial losses. This volatility is driven by factors such as technological developments, regulatory news, market sentiment, and the relatively low market cap compared to traditional assets, making prices susceptible to sharp movements based on relatively small inputs. Investing in cryptocurrencies requires a strategic approach and a clear understanding of the market's complexities. Diversification within the asset class, careful risk management, and a long-term perspective are crucial strategies for navigating the crypto space. Investors should be prepared for the possibility of losing their entire investment, underscoring the importance of only allocating funds that they can afford to lose. Prominent figures like Elon Musk have influenced the cryptocurrency market, highlighting the impact of celebrity endorsements and social media on crypto prices. Musk's investment in Bitcoin through Tesla and his vocal support for cryptocurrencies have underscored the growing mainstream acceptance of digital assets, while also illustrating the market's sensitivity to high-profile opinions. As we conclude our journey through the world of cryptocurrencies, it's clear that this emerging asset class represents both the future of money and a new frontier in investment opportunities. With their promise of decentralization, potential for significant growth, and inherent risks, cryptocurrencies invite a bold reimagining of financial systems and investment strategies. In the unpredictable world of investments, where most assets fluctuate with market conditions, a unique category stands out for its ability to not just survive but thrive in volatility: anti-fragile assets. This session explores the intriguing concept of anti-fragility in investments, diving deep into how certain assets gain from disorder, uncertainty, and stress, thereby offering investors unique opportunities to capitalize on the chaos that typically undermines market stability. Anti-fragile assets, a term popularized by Nassim Nicholas Taleb in his book, Anti-Fragile, refers to investments that benefit from shocks, volatility, or stressors. Unlike robust or resilient assets that resist change or recover to their original state, anti-fragile assets actually improve in such environments. This characteristic makes them particularly appealing in a financial landscape marked by rapid technological change, geopolitical tensions, and economic fluctuations. One prime example of anti-fragile assets is certain types of stocks in the technology and innovation sectors. Companies that are poised to disrupt traditional industries or that have business models flexible enough to adapt and grow in unpredictable environments can be considered anti-fragile. These companies not only survive disruptions but use them as catalysts for growth, outperforming the market in the process. Another domain where anti-fragility can be observed is in venture capital investments. Startups operating in cutting-edge technology, healthcare innovation, or new media often thrive under conditions that challenge conventional business models. By betting on radical innovation, venture capitalists embrace the essence of anti-fragility, seeking outsized returns from the very uncertainty that others avoid. Cryptocurrencies, too, can exhibit anti-fragile characteristics. As decentralized assets, they are not only resistant to traditional financial system shocks but can also gain in value and adoption as distrust in conventional currencies and institutions grows. The decentralized and often borderless nature of cryptocurrencies allows them to benefit from global uncertainties and shifts in monetary policy. Investing in anti-fragile assets requires a mindset shift, embracing volatility as an opportunity rather than a risk to be minimized. It involves recognizing that in the disorder lies the potential for significant growth and innovation. However, it also necessitates careful selection and a deep understanding of the forces that drive anti-fragility in different assets. As we conclude our exploration of anti-fragile assets, it's clear that the ability to gain from volatility and chaos marks a paradigm shift in investment strategy. In a world increasingly defined by rapid change and uncertainty, anti-fragile assets offer a pathway to not just weather the storm but to sail ahead of it, turning potential threats into opportunities for growth. In the diverse ecosystem of investment opportunities, index funds emerge as a beacon of simplicity and efficiency for both seasoned and novice investors alike. By encapsulating the performance of entire market indices, these funds offer a straightforward pathway to diversified market participation, combining the potential for long-term growth with the ease of a passive investment strategy. This session explores the intrinsic value of index funds, highlighting how they democratize access to financial markets and serve as a foundational element in a balanced investment portfolio. Index funds track the performance of a market index, such as the S&P 500, by holding all, or a representative sample, of the stocks or bonds within that index. This approach mirrors the index's movements, providing investors with a reflection of the overall market's or a specific sector's performance. The beauty of index funds lies in their simplicity and cost-effectiveness. By passively tracking an index, they typically incur lower management fees than actively managed funds, maximizing the investor's potential returns. The appeal of index funds extends beyond their simplicity to the profound advantage of built-in diversification. Investing in a single index fund can spread risk across hundreds or even thousands of stocks or bonds, mitigating the impact of poor performance from any single investment. This diversification helps to smooth out the volatility inherent in financial markets, making index funds an attractive option for risk-averse investors aiming for steady, long-term growth. The strategy for incorporating index funds into an investment portfolio hinges on identifying one's financial goals, risk tolerance, and investment horizon. By allocating assets across various index funds, including those tracking domestic and international stocks, bonds, and other asset classes, investors can tailor their exposure to align with their individual investment objectives, leveraging the global market's growth potential while managing risk. The ethos of index fund investing is championed by investment luminaries like Jack Bogle, the founder of Vanguard and a pioneer of the index fund concept. Bogle's advocacy for low-cost index investing, based on the principle that most investors cannot consistently outperform the market, has transformed personal finance, empowering millions to invest wisely and efficiently. As we conclude our examination of index funds, their role as a cornerstone of modern investment portfolios becomes evident. In offering an uncomplicated, cost-effective route to market participation, index funds not only simplify the investment process but also embody the principles of diversification, long-term growth, and investor empowerment. In the rapidly evolving world of finance, fintech innovations have emerged as a pivotal force, reshaping how we interact with our investments, manage our finances, and perceive the potential of digital assets. This session delves into the transformative impact of fintech on the investment landscape, highlighting the opportunities and challenges it presents to modern investors. Fintech, short for financial technology, encompasses a broad range of technological innovations, from mobile banking and peer-to-peer payment platforms to cryptocurrency and blockchain technology. These advancements offer investors unprecedented access to financial markets, streamlined transactions, and enhanced portfolio management tools, all while promising greater transparency and efficiency. One of the most significant contributions of fintech to the investment world is the democratization of access to financial services. Platforms that offer robo-advisory services, for instance, use algorithms to provide personalized investment advice at a fraction of the cost of traditional financial advisors, making wealth management services accessible to a broader audience. However, the rapid pace of fintech development also brings challenges, including regulatory hurdles, security concerns, and the need for investor education. As the fintech landscape continues to evolve, staying informed about these innovations, understanding their implications, and adapting investment strategies accordingly will be crucial for success. As investors seek tangible ways to diversify their portfolios and hedge against inflation, real assets such as commodities, real estate, and infrastructure have regained prominence. This session explores the renaissance of real assets in investment strategies, emphasizing their role in providing not just diversification and protection against inflation, but also the potential for real, intrinsic value growth in an increasingly digital and volatile economic landscape. Real assets offer direct exposure to physical goods or properties, distinguishing them from financial assets like stocks and bonds. Their value is derived from their physical attributes and the benefits they provide, such as rental income from real estate, dividends from infrastructure projects, or appreciation in the price of commodities. This intrinsic value makes them less susceptible to market sentiment and more grounded in economic fundamentals. Investing in real assets can serve as a hedge against inflation. As the cost of living increases, so typically does the value of real assets, making them an effective tool for preserving purchasing power over time. For instance, commodities like gold have historically been sought after as a safe haven during periods of high inflation, while infrastructure and real estate often see increased demand and, consequently, value. Incorporating real assets into a portfolio involves understanding their unique market dynamics, including supply and demand factors, geopolitical influences on commodities, and the cyclical nature of real estate markets. While offering potential benefits, real assets also come with risks related to liquidity, environmental and regulatory changes, and the need for specialized knowledge to navigate these sectors effectively. In today's investment landscape, environmental, social, and governance (ESG) criteria have moved from niche considerations to central components of investment decision-making processes. This session examines the rise of ESG investing, exploring how aligning investment choices with personal values on sustainability, corporate responsibility, and ethical governance does not mean compromising on financial returns. Instead, it opens avenues for sustainable wealth creation that also contributes to positive societal and environmental outcomes. ESG investing evaluates companies based on their ecological footprint, social impact, and the quality of their governance. Investors are increasingly recognizing that companies with strong ESG profiles are often better positioned for long-term success, being more resilient to regulatory changes, environmental risks, and social shifts. This awareness has spurred the growth of ESG-focused funds that aim to invest in companies leading the way in sustainability, social responsibility, and ethical leadership. The appeal of ESG investing lies in its dual promise: the potential for competitive financial returns and the opportunity to drive positive change. Studies have increasingly shown that there is no inherent financial trade-off in choosing ESG investments. On the contrary, ESG factors can be indicative of operational excellence, innovation, and risk management prowess within companies, contributing to their financial performance and investor returns over time. Investors need to scrutinize ESG ratings and reports, understand the methodologies behind them, and consider how ESG factors align with their investment goals and risk tolerance. Implementing ESG criteria into investment strategies requires due diligence and a proactive approach to portfolio management. This holistic approach ensures that ESG investing is not just a checkbox exercise but a meaningful integration of values into the investment process. As we conclude this exploration of ESG investing, it's clear that the movement towards sustainable and responsible investment practices is not just a trend but a transformation in how we define value. In marrying financial objectives with the desire to contribute to a more sustainable and equitable world, ESG investing offers a compelling strategy for the conscientious investor. As we conclude our in-depth exploration of the modern investment landscape, it's imperative to look ahead, charting the course for navigating the future of investing. This final session synthesizes the insights from previous discussions, emphasizing the importance of adaptability, continuous learning, and strategic planning in seizing the opportunities and mitigating the challenges that lie ahead in the rapidly evolving financial markets. The future of investing is marked by rapid technological advancements, shifting global economic powers, demographic changes, and increasing emphasis on sustainability and ethical investing. These trends are not just reshaping the investment options available but are also redefining the strategies investors must employ to achieve financial success and make a positive impact on the world. Adaptability and a commitment to continuous learning emerge as crucial traits for investors aiming to thrive amidst change. Staying informed about global economic trends, technological breakthroughs, and shifts in consumer behavior will enable investors to anticipate market movements and adjust their portfolios accordingly. Strategic planning, grounded in a clear understanding of one's financial goals, risk tolerance, and investment horizon, remains fundamental. Diversification across asset classes, geographic regions, and sectors will continue to be a key strategy in managing risk and capturing growth, ensuring resilience against market volatility and uncertainty. As we stand on the cusp of the future, it's evident that the principles of ethical and sustainable investing will play an increasingly central role. Investors will have the opportunity and responsibility to shape the future, not only in terms of financial returns but also in contributing to a sustainable and equitable global economy. This comprehensive exploration of the modern investment landscape, we invite you to take the insights and strategies shared in these sessions and apply them to your own financial journey. Whether you're navigating the volatility of cryptocurrencies, embracing the stability of government bonds, or aligning your investments with your values through ESG criteria, the future of investing is ripe with opportunities for growth, impact, and innovation. Your future and the world's. Remember, investing is not just about building wealth, it's about shaping the future. The choices you make today can contribute to a more sustainable, equitable, and prosperous tomorrow. So, we encourage you to stay curious, stay informed, and stay engaged with the evolving dynamics of the financial markets. This journey through the investment landscape, don't let the learning stop here. Subscribe to our channel for more insights, tips, and strategies to empower your investing journey. Together, we can navigate the complexities of the financial markets, making informed decisions that lead to financial success and a positive impact on the world.